What if I told you that silver didn't just pull back this week? It may have just received a full-blown warning shot from the Federal Reserve, because that's what this weekend feels like. It's Sunday. The market is closed. The charts are frozen. The headlines have cooled off just enough for most people to stop paying attention. But under the surface, something changed, and it changed fast. Only days ago, silver looked like it was carrying serious momentum. Bulls were talking about breakout continuation. Traders were leaning into the inflation story. Precious metals still had that powerful, hard asset appeal. And then the Fed stepped in, held rates steady, but delivered a message the market did not want to hear. The path ahead may be more hawkish than investors were pricing in. Reuters reported that after the Fed decision, the dollar strengthened, rate hike expectations jumped, and silver fell to $69.41 on June 17th, before dropping further to $65.96 on June 18th. Meanwhile, Yahoo Finance showed silver July futures at $64.91 on June 19th at 12:59:58 p.m. Eastern Daylight Time. Source Yahoo Finance. Now that matters, because silver is not the kind of asset that likes to be caught in a macro crosswind. It is part precious metal, part industrial metal, and all emotion when volatility shows up. When the dollar surges, when bond expectations shift, when inflation fears suddenly cool, and when the Fed sounds more willing to squeeze than soothe, silver can go from hero to chaos in a heartbeat. So tonight, we need to answer one big question. Did the Fed just flip the silver market? And is Monday about to get ugly? Because if you're holding silver, trading silver, watching mining stocks, or trying to figure out whether this dip is a buy the fear setup or the beginning of a nastier flush, you need to understand what really happened this week. This is not just about one red candle. This is about the psychology of a market that had one story in mind and suddenly got hit with another. And what makes this more dangerous is that both the bull case and the bear case are still alive at the same time. That's right. On one hand, the short-term tape just turned shaky. On the other hand, J.P. Morgan still sees silver ending 2026 around $85 an ounce, while also warning that a hawkish Fed, pressure on gold, industrial demand shifts, tariff effects, and speculation can cause violent swings. So this is the kind of setup that can hurt people in both directions. If you're too bullish, you may ignore a macro reset that isn't finished yet. If you're too bearish, you may get run over by one of the most structurally explosive metals on the board. That's why in this video, we're going to break down exactly what the Fed changed, why the dollar matters so much, what the latest silver price action is really telling us, why the US-Iran agreement also played a role in this move, what could happen when futures reopen, and the key scenarios that could make Monday either a controlled reset or a very ugly continuation lower. And trust me, the details matter here. Because silver is one of those markets where people don't usually panic at the right time. They panic late, they chase late, and they often misunderstand whether a violent move is a breakdown or a setup. So let's slow this down, strip away the noise, and get to the real story. What exactly shocked silver this week? Let's start with the cleanest picture possible. As of this weekend, the most recent verifiable silver futures quote from your source set is Silver July 2026 futures at $64.91 per ounce, down $1.41 or 2.12%, with Yahoo Finance timestamping that quote on June 19th at 12:59:58 p.m. Eastern Daylight Time. Yahoo Finance. For spot silver context, Reuters reported silver at $69.41 per ounce on June 17th, immediately after the Fed decision shifted market expectations, and then at $65.96 per ounce on June 18th, a sharp drop in just one day as the dollar climbed and the market digested the Fed's hawkish tone. That alone tells you this is not a sleepy metals market right now. This is not silver drifting sideways. This is silver taking a fast hit in response to a macro repricing. And that's important, because whenever silver falls this hard this quickly, the first instinct people have is to assume the long-term thesis is broken. But that's not always true. Sometimes a violent drop is a structural warning. Sometimes it's a positioning flush. Sometimes it's the market violently adjusting to a new interest rate and dollar narrative. The key is understanding which one this is. And to do that, you have to go back to the moment the market's mood chan. Now here's where a lot of people get tripped up. They hear that the Fed held rates steady, and they assume that should be neutral or even supportive for metals. But markets don't trade only on the current rate. Markets trade on the future path. And according to Reuters, the Fed held its benchmark interest rate steady, but projections showed that 9 of 19 policymakers saw a need to raise rates later this year, and markets sharply increased expectations for a December hike after the announcement. Reuters noted that the market's pricing for a December hike jumped from 61% before the Fed decision to 78% on June 17th, and then to 85% on June 18th. That's the real shock. Not that the Fed moved, but that the Fed reframed the road ahead. And for silver, that matters enormously, because silver doesn't generate yield, it doesn't pay interest. So when the market starts believing rates may stay higher for longer, or even rise again, the opportunity cost of holding silver becomes more relevant. Suddenly cash looks better. Suddenly the dollar firms up. Suddenly traders begin rotating away from metals and toward assets that benefit from tighter financial conditions. That's why this week felt like a flip. The market had one script in its head. Maybe the Fed was close to done, maybe inflation fear would keep hard assets supported, maybe metals could keep pushing. Then the Fed reminded everyone that the easing story may not arrive on the timeline bulls were hoping for. And when a market is priced for one emotional outcome and gets another, the reaction can be brutal. That's exactly what silver just experienced. If you want to understand why silver got hit so fast, you have to understand the dollar. Reuters reported that the US dollar index, or DXY, hit 100.01 on June 17th, its highest in nearly a week, and then climbed to 100.80 on June 18th, touching a one-year high after the Fed's hawkish tilt pushed rate hike expectations higher. That is not background noise. That is the pressure point. Silver is priced in dollars, so when the dollar rises, silver often becomes more expensive for overseas buyers, and that tends to put downward pressure on price. It's one of the oldest relationships in the macro playbook. It's not perfect every day, but when the move is strong enough, it matters. And this week, the dollar move was strong enough. So while silver bulls may want to focus on supply deficits, industrial demand, inflation hedging, and the long-term bull case, the short-term reality is simple. A stronger dollar can overpower those narratives in the near term. That doesn't mean the structural bull case disappears, but it does mean timing gets harder. And timing, especially in silver, is often what separates conviction from pain. Because silver is not gold. Not exactly. Gold is usually the cleaner monetary fear trade. Silver is more unstable. It has precious metal behavior when the market wants safety, but it also has industrial sensitivity when economic narratives start changing. And because the silver market is smaller and thinner than gold, it can overshoot in both directions. JP Morgan explicitly points out that silver is roughly a tenth the size of the gold market, with about 60% of demand linked to industrial use, which makes it inherently more volatile. The bank also warns that a materially hawkish shift by the Fed could call the broader precious metals rally into question and hit silver harder than gold. That's the part you cannot ignore tonight. The Fed may not have killed silver, but it may have triggered the kind of macro environment that exposes just how unstable silver can be when momentum breaks. Now there was another piece of this puzzle that traders need to respect. This was not just a Fed story. It was also an inflation story. Reuters reported that on June 18th, the US and Iran released the text of an interim agreement aimed at ending their war, and that the development helped knock oil prices lower, cooling immediate inflation concerns. Reuters noted Brent futures fell to their lowest since early March following the agreement, and that this helped shift the mood around precious metals. Why does that matter for silver? Because when geopolitical stress rises and oil spikes, markets start thinking about inflation risk, supply shocks, and hard asset hedges. That can be supportive for metals, but when geopolitical relief arrives and oil cools, some of that urgency disappears. So in silver's case, the market got hit from two directions almost at once. First, the Fed got more hawkish than the market hoped. Second, the geopolitical inflation premium started easing. That's a nasty combination. Because now the inflation hedge trade gets weaker at the same time that the dollar gets stronger. And when that happens, silver can drop hard even if the bigger secular story is still intact. This is why you should be very careful with simplistic headlines. If someone says, Silver is down because the Fed held rates steady. That's incomplete. If someone says silver is down because war fears eased, that's also incomplete. The real story is the interaction. The Fed hardened expectations. The dollar surged. Oil cooled. Inflation anxiety backed off. And silver, which had been supported by a more favorable macro mix, suddenly had to reprice. That's what made this move feel violent. This is the question everyone wants answered on a Sunday night. Is silver actually breaking down? Or is this just one of those classic silver shakeouts that looks terrifying before the next leg higher? The honest answer is this: we do not know yet. But we do know what to watch. A true breakdown is usually not just about one ugly drop. It's about failed recovery. It's about the market trying to bounce and getting rejected. It's about former support turning into resistance. It's about bullish narratives losing their ability to produce bullish price action. A flush, on the other hand, can look horrible at first. It can scare out weak hands. It can trigger emotional selling. It can produce the exact kind of Sunday night fear that gets people positioned the wrong way for the next move. But if the market stabilizes, finds sponsorship, and starts reclaiming key levels, then what looked like disaster can turn into a reset. So what are the obvious reference points from the data we have? You have silver around $69.41 on June 17th, $65.96 on June 18th, and $64.91 in July futures on June 19th. That gives you a short-term damage zone. If the market reopens and can't stabilize above that mid-60s region, traders are going to start treating this as something more than a one-off reaction. But if silver can absorb the Fed shock, hold the line, and begin pushing back toward the upper 60s, then the bigger bull camp will argue that this was simply a macro scare inside a still powerful long-term trend. That's why Monday matters. Not because Monday alone decides everything, but because Monday tells you what kind of buyers are left. Are there aggressive dip buyers waiting for this reset? Or did the Fed just convince the market that silver needs a deeper cooldown first? That battle is about to begin. Let's talk bear case. If Monday opens with continued dollar strength, if rate hike odds keep firming, and if silver fails to attract real buying interest, then the market could easily interpret this week's drop as the start of a more meaningful unwind. And here's what makes that dangerous. Silver is crowded when it's exciting. It attracts momentum traders, macro traders, inflation chasers, precious metals believers, industrial demand bulls, and speculators who want explosive upside. That's part of what makes silver so powerful in a bull run, but it's also what makes it nasty when the narrative shifts. Because once a crowded trade loses altitude, people don't exit neatly. They rush. And that can create the kind of Monday move that feels disorderly, especially if futures reopen and the market immediately starts testing whether Thursday and Friday were enough selling, or only the beginning. Remember, J.P. Morgan specifically warned about speculative froth in silver, and about the risk that retail and investment flows can drive the price beyond fundamentals before sharp corrections hit. The bank also emphasized that silver's smaller market size makes it more volatile than gold. That means if confidence wobbles, silver can overshoot on the downside just as violently as it overshoots on the upside. And if you're wondering what could fuel that uglier Monday scenario, here are the ingredients. 1. More hawkish Fed interpretation. 2. A dollar that refuses to cool. 3. Falling inflation anxiety because oil remains soft after the U.S.-Iran agreement. 4. Gold staying weak, which removes an important psychological anchor for the metals complex. And 5. Traders realizing they may have been too early to assume the Fed was done exerting pressure. If those forces stay in place, Monday can become less about bargain hunting and more about protection. That's when the tone changes from buy the dip to wait for proof. And once a market enters wait for proof mode, it can stay heavy longer than people expect. But now let's flip it. Because if you only see the bear case here, you may miss what makes silver so dangerous to short after a panic move. The biggest bullish counterargument is that this may already be a lot of bad news priced in very quickly. Think about the sequence. The Fed shocks the market with a more hawkish path. The dollar surges. Silver drops from roughly $69.41 to $65.96, and futures print $64.91. That is a real move. A lot of emotion has already been released. A lot of late longs may already be gone. And if the market decides that the Fed's message was hawkish but not necessarily a game-ending event, silver could do what it often does best: snap back harder than people expect. Don't forget, the broader structural case is still alive. JP Morgan continues to argue that silver has meaningful upside potential and expects prices to end 2026 around $85 per ounce. That outlook is tied to factors like tight supply conditions, industrial demand, and silver's role in broader precious metals positioning, even though the bank also warns about volatility and macro risks. So if buyers see this week's move as a hawkish scare rather than a structural collapse, Monday could become the first test of resilience. A stable open, a weaker dollar intraday, or even just a lack of follow-through selling could be enough to trigger short covering. And silver short covering is rarely gentle. That's the thing about silver. It doesn't need perfect fundamentals to rip. It often just needs one side of the trade to become too confident. So if everyone shows up Sunday night expecting disaster, but the market opens and refuses to break further, the tone can change quickly. That's why the setup is so tricky. The market may indeed get ugly Monday, but if too many people expect ugly, silver has a habit of turning that fear into fuel. Here's the part long-term investors need to hear. Even if Monday is ugly, that does not automatically destroy the 2026 silver story. In fact, one of the most important things JP Morgan points out is that silver sits at the intersection of precious metals demand and industrial demand. The bank says roughly 60% of annual silver demand is tied to industrial applications, that the silver market has been running in a fundamental deficit in recent years, and that supply growth is not always responsive because much silver is produced as a byproduct of other metals. That matters, because it means silver's long-term path is not solely determined by one Fed meeting. The Fed can trigger repricing, the dollar can pressure timing, speculation can amplify moves. But over a bigger horizon, silver still has underlying structural forces that bulls care about. At the same time, the long-term silver case is not bulletproof. JP Morgan also warns that high prices themselves can become a problem, especially for industrial users like solar manufacturers, who may try to reduce silver usage or substitute with alternatives if silver becomes too expensive. The bank also flags tariff uncertainty, import dependence, and the risk that a hawkish Fed could pressure the whole precious metals complex. So here's the right way to think about it. The long-term bull case may still be intact, but the path is not smooth. This is not a straight-line market. This is a market where macro shocks can temporarily overpower structural strength, and if you're trying to trade silver like it owes you a clean trend, silver will punish you. That's why this weekend setup matters so much. It's not just about whether Monday is red or green. It's about whether the market is entering a new phase where macro pressure dominates for a while, or whether this was a necessary purge inside a still bullish year. So let's get practical. If you're serious about this market, what should you actually be watching? First, the dollar. If the dollar stays elevated or pushes even higher after last week's one-year high move, that's a problem for silver. Reuters tied last week's pressure directly to the stronger dollar and rising rate hike expectations. Source second, follow-through. Was Thursday-Friday the reaction, or the beginning? If silver reopens and immediately starts leaking lower again, the market is telling you the repricing isn't done. Third, bounce quality. Not all green candles are bullish. A weak bounce that stalls quickly can be even more bearish than an immediate dump because it shows buyers are hesitant and sellers are still in control. Fourth, gold. Silver often behaves worse when gold is weak and better when gold stabilizes. Reuters noted that gold also came under pressure after the Fed's hawkish signals. Fifth, inflation narrative. If oil remains soft and the market continues to believe geopolitical risk has cooled, some of the urgency behind the hard asset trade may remain muted. And finally, sentiment. This is harder to quantify, but easy to feel. Are traders talking like the dip is a gift, or are they suddenly nervous, cautious, and defensive? Because silver is one of those markets where tone can shift before charts fully confirm it. That's why Sunday night matters. The chart is one thing. The emotional state of the market is another, and right now that emotional state has been shaken. Here's my biggest warning tonight. Both bulls and bears can get trapped here. Bull traps happen when people assume every silver drop is just a discount. They ignore the fact that macro conditions changed, that the Fed reset expectations, and that a stronger dollar can keep metals under pressure longer than expected. Bear traps happen when people see one violent flush and assume the whole trade is dead. They forget silver's tendency to overreact, to punish late shorts, and to snap back fast once the panic clears. So the worst thing you can do right now is become emotionally certain. Certainty is expensive in silver. Respect is cheaper. If you're bullish, you need the market to prove it can absorb this shock. If you're bearish, you need the market to prove it can't. That's why the phrase "Monday could get ugly" is powerful, but incomplete. The more accurate phrase is this: Monday could become decisive. Because Monday is where we find out whether this Fed-driven reset was a warning or a washout. And that difference changes everything. So let's put it all together. Silver entered this weekend under real pressure. The most recent verifiable futures quote showed silver July 2026 at $64.91, after Reuters documented a drop from $69.41 on June 17th to $65.96 on June 18th. Yahoo Finance source. The immediate catalyst was the Fed, not because it hiked, but because it sounded more hawkish than the market wanted, lifting the dollar and increasing expectations for a later rate hike. Reuters reported that those expectations rose significantly after the meeting, while the dollar index advanced to a one-year high by June 18th. At the same time, the U.S.-Iran agreement cooled oil and inflation fears, removing part of the geopolitical support that can help precious metals. That combination hit silver hard, and now the market faces a test. If silver stabilizes, this could go down as a violent but temporary macro shakeout inside a bigger bullish 2026 story. A story that JP Morgan still believes could carry silver toward $85 by year-end 2026, despite major volatility risks. But if silver fails to stabilize, if the dollar keeps climbing, and if Monday brings follow-through selling instead of dip buying, then this weekend may be remembered as the moment the market realized the Fed had flipped the script. And that is why this Sunday matters. Because the biggest moves often begin in the quiet window when the market is closed, the headlines are fading, and almost nobody is taking the time to connect the dots. Tonight the dots are clear. The Fed hardened the tone. The dollar surged. Silver cracked. Now Monday gets to decide whether this is fear that will fade or pressure that will spread. So here's the question I want you to think about before futures reopen. Was this week's silver drop the start of something uglier, or the kind of panic flush that sets up the next major opportunity? Drop your view below. Bullish bounce or bearish continuatio.